If you are currently working, and I mean, especially if you're under the age of, say, 40,
Hmm.
you really need to understand something that kind of runs counter to almost every piece of financial advice you hear. For most people, your most valuable asset isn't your investment account. It isn't what you have. It's the income you are going to earn over the next 30 years.
That's it. That is the absolute starting point.
It's literally the present value of your future earning potential.
Right. And understanding your entire personal economy, it doesn't begin with agonizing over which stock to buy. It begins with this fundamental recognition that your career, your skills, your experience, what economists call human capital, is an asset.
An asset that you have to manage.
You have to manage it, diversify it, and protect it,
Yeah.
just like you would any other complex investment.
So our mission today is a really deep dive into this dual nature of building wealth. We're going to be synthesizing some really high-level financial theory from Lifecycle Finance, big economic reports.
And we're going to ground it. We're going to connect it with the practical day-to-day realities of how you build wealth, especially when you're up against, structural and systemic barriers.
Exactly. We're tackling the big question. How do you stay financially strategic as an individual in a world that's governed by these massive forces you just can't control? It's dense stuff. But we're here to pull out the sharpest insights you need.
Hmm.
And since we're talking about making smart choices for your future, if you want to keep accelerating your financial knowledge and just make sure you're making the right calls, you should absolutely subscribe to Money Mindset.
Definitely.
So let's dive right in. High-level theory first. Thinking about your career as a financial instrument, a stock or a bond.
Right. The foundational concept here is what we call human capital, or HC.
Yeah.
Economists define it as the calculated present value of all the income you can reasonably expect to earn over your entire life.
Discounted back to today's dollars.
Discounted back to today. And for a young professional, that number can be, staggering. It can easily be 50, 75, sometimes even 95% of your total net worth. It just dwarfs your early retirement savings.
It makes that small brokerage account look tiny.
Exactly.
So we're not just talking about your job. We're treating your skills, your industry, your whole career path as this massive front-loaded bond that pays out over time and is slowly depleted as you get closer to retirement.
That's the model.
So the critical question becomes, what kind of asset is this huge thing I own?
Precisely. And this is where economists, guys like Zvi Body and Moshe Milevsky, they came up with this really powerful analogy. Your human capital behaves just like a financial asset, either a stable, predictable bond or a volatile, unpredictable stock.
And figuring out which one you are is step one.
It's crucial for understanding your total household risk.
Okay, let's break down the bond idea first. If my job is bond-like, what does that actually look like?
So think about a high-quality government bond. It's all about stability, reliable payments, predictable cash flow. Bond-like careers have that. Super stable value, very low income fluctuation outside of, cost of living adjustments, and critically, an extremely low risk of being fired.
So we're talking about tenured professors, government jobs.
Tenured professors, civil service workers, maybe a utility employee, their income stream is just highly certain. It continues reliably until they retire or something major happens with their health.
The key word is certainty. High predictability, low volatility. You pretty much know what you're making next year, and you know you'll have that job.
Yeah, that stability is like a built-in buffer against almost any financial uncertainty out there.
Okay, now let's contrast that with the stock-like career. This feels much more modern.
It is. It's much more volatile, much riskier, but often it comes with a much higher potential ceiling.
So this is where most of the ambition is in today's economy. What does that volatility actually look like?
A stock-like career acts like a volatile stock. Its value can see these abrupt, nonlinear changes up or down, and it's all driven by news.
News like what?
This is the person climbing the corporate ladder really fast, maybe in finance or tech. It's the high-commission salesperson, the management consultant. Or, the most extreme version is the self-employed person, the entrepreneur.
So the news could be landing a massive client.
Right, which is a sudden, huge jump in the value of your human capital. Or, on the flip side, the news could be devastating. A company reorg, a venture capital pullback, a big layoff, that immediately wipes out value.
And the really painful part is the correlation you mentioned. These jobs are often tied to the overall economy.
Yes, they have a high market beta. So if the stock market is booming, your tech stocks are up, and your career is thriving, you're getting bonuses, promotions, your business is growing,
You feel like a genius.
you feel invincible. But if the market crashes, a high beta career is simultaneously more likely to see a layoff, a hiring freeze, or major business slowdown.
Ah, so you get hit on both sides.
Exactly. Your investment portfolio craters and your main source of income, your human capital, is suddenly at risk. It just amplifies the pain.
Okay, that brings us to the real strategy here. Holistic diversification. You can't just look at your 401k.
You can't. Traditional financial planning makes a huge mistake by only focusing on the portfolio. You have to look at the entire household balance sheet. You have to balance the risk of your job with the risk of your investments.
This is probably the most actionable takeaway from this whole section. You use one to offset the other.
That's it.
Okay, so let's use an example. I'm a young investment banker. My career is super stock-like, high potential income, but huge volatility, totally tied to the market. What should my portfolio look like?
If your human capital is that volatile, that high beta,
Yeah,
your financial portfolio needs to be more conservative.
the opposite.
The exact opposite. You should intentionally have a larger allocation to bonds, stable fixed income, maybe just a very large cash reserve. Your goal is to manage the total volatility of your household.
Because your job is already a massive, undiversified bet on the market.
You don't need to double down on that same risk in your brokerage account.
This makes so much sense because the classic advice for a young person is go 100% stocks, you have decades to recover.
And that advice completely ignores the volatility of their single biggest asset, their career.
Right. So now let's flip it. What about the stable government employee, the bond-like worker, say, a municipal water engineer?
That person has near perfect income security. Their job acts as a huge financial buffer against any market chaos.
They're the one who can afford to be aggressive in the market.
Absolutely. They are in a fantastic position to take on way more risk in their financial portfolio. They should own more stocks, maybe even some venture capital or private equity if they can get it.
Because the stock market's volatility is counterbalanced by their job stability.
Precisely.
So here's where it gets really interesting, because we know human behavior messes all of this up.
It always does. We see this massive behavioral bias trap. The data reliably shows that people fail to diversify this way because their personality drives both their career choice and their portfolio choice.
Meaning the risk taker who chooses the high-growth, stock-like startup
Is often the exact same person who loads up their E-Trade account with high beta tech stocks or meme stocks.
So you're saying the adrenaline junkie is trying to skydive on the weekend, putting all their money in leveraged crypto, all while running a super volatile startup.
Essentially, yes. They are choosing volatility on top of volatility. They amplify their total risk exposure dramatically. And this just demonstrates a core truth we see again and again. Behavioral biases reliably lead to poor investment decisions.
They create a system where one bad recession could cause a catastrophic failure in both their income and their savings at the same time.
It's a domino effect.
Wow. Okay, so one last thing on human capital theory. Investment. If HPC is our biggest asset, where should we be putting our money early on?
The theory is pretty clear here. For younger workers, spending money to advance your career, so additional education, specialized training, certifications, that often yields a much, much greater return on investment than just traditional saving.
A better ROI than opening a Roth IRA?
How? Because that investment turbocharges the value of the biggest asset you own. Think about it. A $10,000 course that boosts your lifetime earning potential by $50,000 a year for the next 30 years. That's an infinitely better investment than putting that 10 grand in the stock market for a couple of years.
Right.
Even if it means you delay saving for a year or two, that modest investment in early career training can create so much more long-term economic value than relying on the compounding of those first few small savings contributions.
So this drives home another one of those key findings, right?
It does. A small number of financial choices determine most long-term outcomes. And this is one of the biggest. Choosing where to put your resources early in life. Do you maximize your future earning potential, your human capital, or do you focus on immediate saving?
You have to grow the engine before you can maximize the compounding.
That's the right way to think about it.
Okay, so we've established that maximizing the value of your career, your human capital, that's step one. Now, how does that asset actually turn into real tangible wealth that supports us later in life? We have to look at the cold, hard formula.
This takes us from the individual view to the big macroeconomic perspective. It's called the intertemporal budget constraint. It's the core equation for how wealth changes over time.
Okay, what is it?
It says that the change in your wealth, let's call it delta W, over any period, is the sum of three things. Saving, which is S, capital gains, G, and net interfamily transfers, IFT.
So change in wealth equals saving plus gains plus transfers.
Delta W equals S plus G plus IFT. That's the whole picture.
But most of us are taught to believe the equation is just delta W equals S. We think wealth is just a function of how disciplined we are at saving.
Exactly. We think if we save $10,000 this year, our wealth grows by $10,000. And while that's intuitive, it's incomplete. And for a lot of people, it's actually misleading.
So what does the data show? When we look at the big picture, say from the mid-90s to 2016,
The data tells a totally different story. The key insight is that the total change in household wealth was way, way bigger than the total amount of money saved.
so the increase in net worth was much larger than what people put aside from their paycheck.
Dramatically larger. Which leads to this critical conclusion. Capital gains and interfamily transfers dominate wealth accumulation over the life cycle, especially for people at higher wealth levels.
Wait a second. If wealth change is that much bigger than saving, that means the part of wealth growth that's purely from our saving decisions, income minus spending,
Yeah.
is actually a pretty small piece of the pie.
It reframes the entire narrative. Now, saving is necessary. You can't get capital gains if you haven't saved enough to buy the assets in the first place.
Right, saving is the input.
It's the input. But the actual accumulation, the exponential growth that turns thousands into millions, that comes overwhelmingly from the appreciation of those assets, the G, and the transfers, the IFT.
Let's put that in context. Why did capital gains G dominate so much between 1995 and 2016?
Well, you're looking at a period of massive asset inflation. Housing, the stock market, all fueled by historically low interest rates.
Right.
If you saved $10,000 in 1998 and bought an S&P 500 index fund, by 2016, that might have turned into $40,000 or $50,000. The $10,000 was your saving, the S. But that extra 30 or 40 grand, that was all capital gain, the G.
So this is why portfolio decisions matter so much, but also why you can't time the market.
Exactly. It's a crucial reminder that market cycles are unpredictable in both timing and direction. You can't predict when the gains will hit, but you have to be in the market when they do.
So the advice to just save, save, save is a little misleading because it's only focusing on the input, not the growth engine itself.
It creates a false sense of control. You can control S, your saving, but G, the gains, is largely driven by these huge macro forces. This also helps explain why different generations have such wildly different wealth outcomes.
You mean the timing of when you were born matters?
It matters a lot. Think about two people who saved the exact same percentage of their income their whole lives. One retires in 2007, right before the crash. The other retires in 2021 after a decade-long bull run.
Their outcomes would be completely different.
Totally different, and it had nothing to do with their discipline. It was just the luck of the market cycle they happened to hit during their peak accumulation years.
Okay, so let's look at the part people do control. Saving, the S. What does the typical life cycle pattern look like there?
Well, conventionally defined saving, so income minus consumption, it follows the pattern you'd expect. It's pretty high early in your career. Then it gradually steps down as you get closer to retirement, kids' college, paying off the mortgage.
And then it goes negative in retirement.
Right, that's the saving phase where you're drawing down your assets to live.
And if we plot income versus consumption, we see that classic hump shape for income, right?
Yeah, your income follows that career arc. Rises, peaks in your late 40s or 50s, and drops in retirement. But consumption is different. It just steadily increases your whole life and only really levels off after you retire.
But there's something weird there with retirees and how they spend their money, isn't there?
There is. We see this widespread reluctance for retirees to spend down their wealth, which suggests that even in retirement, capital gains and maybe some transfers are sustaining their wealth. Their assets are basically appreciating faster than they're spending them.
Wow. But that implies a huge vulnerability for people who haven't accumulated enough capital. If you increase your spending too quickly relative to your income, what we call lifestyle creep.
You're in trouble.
Yeah.
If you keep chasing what your neighbors are buying, you're getting the saving component, the S, that you need to buy the assets that generate the gains, the G.
And that's a direct link to another one of those core principles.
Absolutely. Lifestyle inflation reduces the percentage of income saved. If you compromise your saving rate during your prime earning years, you just shrink the pool of capital that can grow when the market takes off.
Okay, let's zoom in on how this varies by socioeconomic status. I'm guessing the differences are pretty stark.
Extremely stark. The highest education group, so college degree or higher, they accumulated way more financial wealth. And when you control for capital gains, it just implies they saved a lot more. They had a much higher S.
And the bottom half of the income distribution.
They hold very few financial assets. Their wealth is mostly tied up in their house, if they own one, and their retirement accounts. It suggests they're mostly saving through forced mechanisms, like a 401k deduction, not active, discretionary saving.
So the bottom 50% is really banking on their house as their main asset?
Yes. And while everyone starts to saving at older ages, for the wealthiest retirees, their capital gains are so large that their wealth just keeps growing, almost on autopilot.
We have to talk about the interfamily transfers, the IFT component. The numbers on inheritances are just staggering.
The concentration is extreme. It's a massive driver of wealth inequality. About half of all inheritances are for amounts under $50,000.
Which is helpful, but not life-changing.
Right, it's a nice buffer, helps with a down payment maybe.
Right.
But all those smaller transfers combined only account for about 5 or 6% of the total dollars transferred in the economy.
So where's the rest of the money?
The top end, the 6 to 7% of transfers that are above $600,000, they account for about half of all the dollars transferred. Half. It shows that the impact on wealth concentration is just driven by these massive amounts of capital moving between the wealthiest families. It's a systemic advantage that just compounds and compounds across generations.
So you get the capital, you buy the appreciating assets, the assets generate gains, and the cycle just keeps going.
That's the cycle.
Okay, everything we've just talked about, human capital, diversification, the dominance of capital gains, it all falls under individual strategy. But that conversation is, frankly, incomplete. It's almost insulting without talking about systemic barriers.
It is.
If wealth comes from owning appreciating capital, what happens when structural inequality stops you from getting that capital in the first place?
That is the essential pivot. For so many communities, the playing field isn't just tilted. The rules of the game are completely different. And that's why we have to shift to the structural view.
And we're using the framework from the Chicago Urban League for this, the laddered path to wealth building.
Right, because this framework acknowledges that individual strategy alone is not enough. You need policy, you need collaborative solutions to deal with these systemic obstacles.
And the urgency is just defined by the scale of the problem. The report highlights the racial wealth gap in Chicago, where the average net worth for a Black family is reported as basically zero, compared to an average of $210,000 for white families. And when the number is zero, save more is not the answer.
It's not. When the average net worth is zero, you aren't optimizing a portfolio. You're building a foundation from absolutely nothing. And this isn't just a moral issue. It's common sense economics. McKinsey estimated the U.S. lost trillions in potential growth because of this inequality.
It constrains opportunity for everyone.
It does.
Okay, so let's climb this 5-stage ladder, starting at the very bottom. Money mindfulness.
This is the prerequisite for everything else.
Yeah.
It's about cultivating a growth-focused relationship with money, shifting away from a scarcity mindset and, replacing bad financial habits with good ones.
And this requires support, like financial counseling for budgeting, understanding credit score.
All the basics. The goal is to build automated systems that promote good habits.
We talk about automation all the time because it just eliminates the need for daily willpower. You automate your savings, you automate your bill payments.
And that links back perfectly to one of our core ideas. This foundational stage is essential because automation reduces the number of decisions vulnerable to human error.
Right. You automate the boring stuff so you can free up your mental energy for the big picture things, like investing in your career.
Exactly.
Okay, what's the next rung up from that foundation?
Stable security. You can't build wealth if your basic needs aren't met. So this stage is all about stable housing, stable employment, food security, healthcare.
So the focus is on things like workforce development programs that connect people to secure jobs.
Right, you have to stabilize their income to create that reliable platform for growth. Without a stable income, your human capital is just way too stock-like and completely unpredictable.
Okay, so once you have the stability, the income, and the mindset, then you can move into accumulation. Rung 3, compounding interest.
This is where you move beyond just survival and you actively start exploring ways to build assets. So financial literacy, maybe higher education, entrepreneurship training.
This is where programs that focus on professional development come in.
Yes. Programs that leverage your existing skills to advance your career and, critically, increase your earning potential. This is that strategic investment in human capital we were talking about earlier.
And what's the one non-negotiable rule for this rung, whether you're compounding money or skills?
Time. Compounding requires staying invested over long periods. It doesn't matter if it's staying disciplined in a volatile stock market or consistently putting in the time to advance your career. Stability and time are the most powerful forces.
You can't panic sell your career when things get tough.
And you can't panic sell your retirement savings. It just sabotages the whole process.
Moving beyond the individual, the fourth rung is community prosperity. This seems to acknowledge that some problems need a collective solution.
Exactly. This stage is about building wealth collectively. Through cooperative economics, shared ownership models, this is transformative because it extends the impact beyond just one person.
So things like summits for small business owners to help them access capital or technology.
Right? Fostering that collective strength and resource sharing. It helps protect against systemic exclusion. It builds resilience for the whole community.
And then the top rung, the ultimate goal, long-term growth, which leads to generational wealth.
This is about making sure the wealth that gets built doesn't just evaporate. It means fostering intergenerational wealth transfer through deliberate planning.
So estate planning, business succession planning.
All of it. Helping families develop wills and trusts, making sure those assets and those crucial inter-family transfers, the IFT, are managed efficiently for the next generation.
Okay, let's drill down into the two most critical assets identified in these frameworks: homeownership and entrepreneurship. And let's look at the surprising data on how they affect inequality.
Right, so homeownership is universally seen as a foundational asset. It contributes to saving, the S, through paying down a mortgage, and to gains, the G, through appreciation.
But the homeownership gap in Chicago between black and white households is over 30 percentage points. So a huge part of the population is just locked out of that capital generator.
They are. And this is where the international data throws us a really interesting curveball. Data from the European Central Bank found that across the Eurozone, primary housing is often the main equalizing asset.
Wait, how can it be an equalizing asset over there, but a key driver of the wealth gap here?
It's a crucial distinction based on who owns the asset. The ECB data shows that housing's share of your total net worth tends to go down as you get wealthier.
So for lower wealth households, the house is often the single biggest thing they own. It's disproportionately important for them.
Exactly. So for a family just starting out, buying that first home is the biggest boost they can get to their net worth. If they own a home, their wealth is relatively more equalized with other new homeowners.
I see. So net wealth is more equally distributed among homeowners than among non-homeowners.
Right, so the main source of the inequality is the gap between those two groups. If you're locked out of homeownership, you're locked out of that critical equalizing asset and the capital gains it generates.
Which means the policy solutions have to focus on enabling homeownership for those who are locked out.
They have to. And the framework proposed several practical ideas. First, things like low-interest mortgage and down payment assistance funds, modeled on programs that have worked in Atlanta and Baltimore.
Directly addressing the capital barrier.
Right. And second, tackling the bias in the lending system through equitable lending reform. This means partnering with banks to use alternative credit scoring.
So looking at things beyond just a traditional credit score.
Yeah, accounting for things that show financial responsibility, like consistent rent, utility, and cell phone payments. It's been shown to expand mortgage access without actually increasing defaults.
And the idea of converting voucher renters to homeowners seems so powerful.
It's a phenomenal idea. The analysis suggests converting just 10% of them could create over 6,000 new homeowners and generate an estimated $1.3 billion in assets for those families. And then there's things like the Heirs Property Initiative, providing legal help to sort out tangled titles on inherited properties.
Making sure that IFT component actually transfers to the next generation.
Instead of being lost to legal limbo.
Okay, let's pivot to entrepreneurship. A major wealth driver, but it plays a very different role in the wealth equation.
The statistics are stark. Black entrepreneurs are 50% more likely to be denied a loan and get less than 2% of VC funding in Chicagoland. So even if they start a business, the system obstructs their ability to scale it and generate meaningful capital gains.
So if housing was the equalizing asset, what does that European data say about owning a private business or stocks?
This is the counterpoint. This explains the dominance of capital gains we saw earlier. Private business wealth and stock ownership are found to have the highest marginal disequalizing effects.
Meaning they're the things that make the rich richer?
They have the highest correlation with total net wealth. These are the assets that, once you get them, they accelerate wealth concentration at the very top. This is the primary engine of multi-generational wealth, but it's also the engine of widening inequality.
Because the access barriers are so high?
Exactly. So if you manage to acquire a successful business or a big stock portfolio, you are using the mechanism that drives wealth concentration. But most people are excluded from that mechanism in the first place.
So the policy responses have to focus on fixing those access barriers.
They do. Things like creating small business wealth and innovation hubs, getting corporations to pledge to spend more with minority-owned firms. And we're also seeing the rise of these cooperative economics models.
Where businesses share resources and ownership.
Right. It helps mitigate the individual risk, that stock-like volatility of a single business venture, by distributing the risk across a whole community.
We've covered the financial assets, but the framework also emphasizes holistic wealth, the things that create the conditions for financial success. Let's start with education, which is really our investment in human capital.
Right. Education determines the starting value of your human capital. And the data shows that Black students are more likely to attend underfunded schools, they face barriers to advanced courses, and they graduate with significantly higher student loan debt.
So they're starting with a structural deficit before they even get their first paycheck.
A huge deficit. It increases their liabilities and can force them into more bond-like, lower risk, but also lower reward careers just to manage the debt.
So how does policy address this in a way that directly helps close the wealth gap?
The key policy idea is implementing universal financial literacy in schools, making sure every single student gets high-quality training in budgeting, credit, investing, the whole works.
It's a critical tool for breaking generational cycles of debt.
And for fostering a culture of asset accumulation early on. It standardizes the knowledge you need to make those small number of financial choices that end up determining most of your long-term outcome.
And we also need pipelines connecting students to high-wage emerging fields.
Absolutely. Developing STEM and emerging industry pipelines, like through hands-on programs, exposes students to in-demand skills early. That translates into long-term access to stable, high-wage jobs, a valuable stock-like human capital with a strong growth trajectory.
And there's statistical evidence that these non-financial factors are even more important for low-wealth households.
The data is unequivocal. Quantile regression analysis showed that at the bottom, wealth percentiles, net wealth levels are much more dependent on covariates like education and income than they are at the top.
So for the rich, it's all about capital gains. For the poor, it's about getting a good education and a steady job.
That's the primary determinant. So policies that boost education and income stability have the strongest, most direct impact on lifting people onto that first run of the ladder.
Moving to workforce development, the employment disparities create a huge drag on people's ability to save.
A massive drag. Black workers face unemployment rates more than twice that of their white counterparts. And almost half of Black workers in Chicago are concentrated in low-wage sectors like retail and food service.
So these are bond-like careers, but with a very low cap on their value.
Stagnant wages, limited advancement. The goal has to be shifting that concentration into higher-wage, future-focused fields. The opportunities in clean energy, biotech, AI.
And we're seeing job training programs for things like solar panel installation.
Exactly. These are jobs that often don't need a four-year degree, but offer stable, well-paying career paths. That's a high ROI investment in human capital right there.
And we need to make sure that employment connects directly to long-term wealth building, to the G component, the capital gains.
That is the critical link. We have to advocate for employer-backed wealth-building benefits, getting large employers to offer stock ownership plans, robust retirement matching.
So that workers are accumulating equity and assets that can grow, not just relying on their paycheck.
Right. It connects their job directly to long-term wealth mechanisms.
Finally, we have to look at the intersection of the criminal justice system and economic opportunity. This is a foundational barrier.
It creates a perpetual drag on human capital value. The unemployment rate for justice-involved individuals in Illinois is nearly 5 times the general population. A criminal record just creates these ongoing barriers to getting a good job.
It turns your human capital into a deeply depreciated high-risk asset.
That's a perfect way to put it. So you can't achieve economic security without justice reform, because stability is that second rung of the ladder.
The solutions have to be things like clean slate legislation.
Exactly.
Right.
And activating offices of reentry. Because access to a job, the very foundation of stable security, is the prerequisite for everything that comes after. Without that, the economic exclusion just perpetuates itself.
This has been a really profound deep dive, synthesizing two very different worlds, individual financial theory and structural economic reality.
Mhm.
On one hand, we learn that financial success requires you to master the vol stock of your career, your human capital, and then build your financial portfolio to holistically compensate for that risk.
And on the other hand, we now see the systemic reality that for most households, wealth isn't built just through saving, the S, but through capturing market-driven capital gains, G, and large interfamily transfers, IFT.
Both of which are heavily skewed toward the top.
And for communities facing those structural barriers, building wealth requires these collaborative, laddered policy interventions. Housing access, quality education, justice reform, all to ensure access to those vital appreciating assets.
And we covered so many critical evidence-based ideas, recognizing that compounding requires staying invested over long periods, understanding that lifestyle inflation reduces the percentage of income saved.
And we saw how a small number of financial choices determine most long-term outcomes, and the absolute need for a system where automation reduces the number of decisions vulnerable to human error.
It all comes down to this core tension.
It does. The individual can and must optimize their saving rate and their career trajectory. But you're operating within a system where capital appreciation is the dominant engine of wealth. And we can't ignore that market cycles are unpredictable in both timing and direction.
Which makes the need for both robust personal saving and structural access to capital so important.
Do they have to go hand in hand?
Which leaves us with the final provocative question for all of you to think about. If our system is fundamentally structured so that capital gains and large family transfers are the most powerful drivers of wealth, how must we evolve our personal strategies and our policy strategies to move beyond just relying on earned income, especially when the structural barriers to owning that capital, to accessing those appreciating assets, are so persistent?